Welcome to the February Investor Advisory Review, where we update things for the economy, the market, planning, investment, and risk management or insurance issues. I hope this Tuesday finds you doing well and you've had a good start to your week, and that so far the start to your year has also been good. That would be awesome. Tonight, we're going to be covering a number of different points, specifically focused on the economy and the markets, and then planning issues in general. As we always start out, these disclosures are designed for your protection. So please read them, take them seriously, because anytime you make any changes, anytime anybody, including myself, makes suggestions to you for things you could do differently, it's very important to make sure that you choose them with information that matches your situation and fits your needs well. Understanding the risks, understanding the tax issues, legal issues, etc., may require more than just whoever you're talking to, including me. You may have to talk to an accountant or an attorney to make sure that the various pieces of your financial life are coming together well for you. As you probably know, finances are complex, not just investing, but how you handle finances in general, cash flow, tax management, legal issues, borrowing money, etc. Want to make sure that you do that in the best way possible for you. And these disclosures are here just as a quick reminder that that's an important aspect to all of our conversations. We will have time for questions, as always. At the end, you'll be given a chance to either chat a question up or raise your hand, and we'll be looking for that to see if there's anything that we can answer for you to make this time together valuable. Tonight, we're going to be talking about the 2025 economic outlook as we see it so far this year, the market tactical analysis, potential investment opportunities, the 8 investor types review, talk about the difference in how we do portfolio management versus other firms, talk about our planning process and how it's client-driven and advisor-managed, and then take time for your questions, and then as a reminder of our next advisory review and how you can participate with that and even bring friends with you if you would like. So as we talk, and we're going to circle back around to this as we get to the end, but which type of investor are you? You may remember we covered this in our last discussion, the 8 investor types. And those types are attached to 3 basic points. One, the goals that you have. Are you looking for growth or income or capital preservation, or maybe a little bit of several of those? Again, the goals you have could be things like retirement or putting your children through school or starting a business. Those are all goals, but when it comes to how you manage money, are you more growth-oriented, more income-oriented, more preservation-oriented? That's what that's referring to in this case. Risk tolerance, how much volatility or loss can you handle? Not that any of us want to have loss, that's never what we're looking for, but how much can you handle if the market were to go south and you were invested more aggressively? Would you be okay with that? Would that make you lose sleep at night and become terribly nervous and uncomfortable? If not, that's important that we build a portfolio that matches your investment goals as well as your risk tolerance. Just understanding simply, are you more of a risk taker or more of a risk avoider? And then last, your involvement. Do you prefer to have more passive or active approach in your investment management? Certainly, we offer full service management using our managed accounts that can even be set up for discretionary work where we can make changes without even talking to clients. But then obviously there are times when clients say, I want to have more involvement in that account. And so which one are you? More active, more passive, somewhere in the middle? And which way do you lean with that? And these are just some of the thoughts to think about when we take a look at the 8 investor types here in a few moments. As we've talked about the U.S. economy, I continue to believe that the U.S. economy is strengthening. I certainly know that there are issues to be thinking about. There are always issues to be thinking about, to be clear, but it seems to me there are more economic strengths right now than there are weaknesses. Even if we're going to be looking at some volatility, meaning the market could have some ups and downs along the way, and they might even be a little more violent sometimes, depending upon how things are happening in the economy, in the world economy, in political issues, both domestic and international. All of these things can then come back together and create an outcome. But if that outcome is overall stronger, that's what we're looking for. And so as you look at the U.S. economy, depending upon where you get your news information from, you might be seeing more information that is a little more scary. I certainly see in some of the mainstream media concerns about how the tariffs could play. And certainly I hear information from different sides that talk about the Department of Government Efficiency and all the money they're finding and what that may mean for people in general. And so these are various issues that we have to consider. But again, overall, I would tell you that I think the U.S. economy is stronger and probably will be so for the remainder of this year and maybe even a good part of next year, even if we have some volatility along the way where it pulls back a bit. I think overall it's going to be up for the year. Which brings me to looking at some of the various issues that we can track. In this case, Consumer Price Index. And what we're looking at here is the CPI, Consumer Price Index, from early in 2019 all the way to the end of this year, looking into next year. I'm sorry, not this chart. This one doesn't show that. It just simply shows the up that we're looking at here. This is as of January 2024. So what we're looking at here is a band of where our inflation has been over the time. And there has been a recent uptick. January of 2025 had a bit of an uptick for the year, maybe one of the highest that we've seen. It's kind of up in this area right over here. But again, probably has more to do with other factors than simply the tariffs, which I think is one of the items being positioned by the mainstream media to say, well, that's the big problem. It's not. I mean, we know things like eggs and killing over, I believe it was 1.5 million birds, chickens. That's going to have a big detriment to certain aspects when you look at supply and demand. And there's other issues too, energy and various factors that can impact that. Having said that, though, I think that overall we're going to see inflation continue to be lower this year, which bodes well for both the economy and the markets as well. When we look at the Fed fund rates, what the federal government charges in interest and then what passes on to banks for business loans and personal loans and mortgages, we can see that they have continued to hold their rate back a bit. They have dropped it down. They're talking about one more rate decrease between now and the end of the year. I think that if the economy were to experience some challenges, like a recession, which I don't think is very likely at this point, you could see them pull rates back more, but I don't think they want to, because I think the reality is if the economy is strong, lowering interest rates is not something the Fed does unless they believe it will help to create liquidity in the economy and the markets. At this point in time, I think they're looking at maybe one more rate decrease, and otherwise than that will probably hold steady this year, which again bodes well for the economy and where we're headed. When we look at the markets themselves, this is the S&P 500 forward-looking price-to-earnings ratio. And what we can see is going back to 1985, we can see various times where there have been recessions because there's been a drop in the forward PE price-to-earnings look. We can see that the most recent time happened in 2020 as a very short-lived experience. And honestly, the downturn in the economy, the recession, was caused more by the pandemic than anything else. But there was concern about what would happen if you remember that time back in first and second quarter of 2020. It was scary. And so people were trying to process what that would look like. But we came through it by the end of that year just fine. Markets have pulled back, which is expected. That's the way things normally work. It has continued to move up. And I think there's a lot of belief that it will move up a little bit higher before it pulls back again. And again, there's a concept we talked about more last time, which is the Fed being able to do a soft landing, meaning that the economy goes up and then comes back down, but it doesn't crash. There's not a recession. There's not a bear market. Rather, the market goes down a bit, more gentle, and then comes back up. And you can see some of these experiences right here where we've seen that kind of thing happen. And I think that we're kind of looking for that same sort of thing here, is that markets probably will go up a little bit higher because it does appear that there's going to be a lot of growth in the economy, both in the US and around the world. And then it looks like we'll have a bit of a pullback at times, hopefully not driven by a recession. And again, I don't think that's very likely at this point in time. If we look at the market, the S&P 500, and this is a chart updated from last month's time. And what I'm going to tell you is I hardly had to move any of these lines because they all had maintained. We see that on-demand volume has continued to increase since we talked last month. We can see relative strength indicator has continued to move up slowly and has held its own. It's stayed above the 50 percentile and done a great job with that. We can see that the MACD, short MACD, moving average convergence divergence, has stayed well above its median line and held its own. And we can see the markets have moved up. And again, these green lines represent ceilings of resistance. And so we can see here, it has been attempting to break through that ceiling of resistance. It's also bounced backwards, and this is what we call the floor of support. It has the initial floor of support, and then there's a bigger one if things were to go south. But you can tell with the 200-day moving average and the 50-day and 20-day moving average, the markets continue to look healthy. And we're well above all three of those indexes, those three indicators at this point in time. And I think that we're probably going to hold that. Again, there might be some more testing where it has to fall a bit and then come back up. But I think that once it breaks through this ceiling of resistance, it's probably going to be a good time for quite a while, whatever that means, whether that could be a few months or a few quarters. But being invested at this time could be helpful and important for you and for your family's wealth and your goals long-term, as well as some of the short-term goals. I decided to also include this time more of a breakdown just on the daily activity of the S&P 500. And what you can see here is you can see our basic floor of support, and then our backup floor of support if things were to go lower. And then you can see our basic ceiling of resistance and then our upper ceiling of resistance. And what we'd hope is it's going to break through this second level. We can tell it's bouncing up into it, came back down, hit the floor of support, moving back up again. These are all indicators that the market sees opportunity and is attempting to take advantage of that. Even if there's a little bit of concern right now, even if there's people that are worried about tariffs, and even if there's people that are worried about issues like the price of gold rising as much as it has, and some of the other impacts that we're looking at. Having said that, we're seeing areas where there are selective buys. Just was sharing with a client today, I saw how Warren Buffett actually made a huge purchase in several different securities this last month. I think, again, he's sort of the epitome of when there's blood in the street, that's the time to buy. There's obviously not any blood in the street, but for him to buy now indicates that he does see some opportunities there that may have long-term growth. So we can talk more about those at an individual time rather than take time to talk about what Warren Buffett's doing here. I will just tell you, he has been making some purchases. He also has probably the highest cash position that he's had in his portfolio in quite some time, maybe even ever, because he's looking for opportunities that he thinks are coming. So again, much like you, we have cash in our portfolios because we're looking for these opportunities as well. And I expect that as you're looking down the road, you'll see us make purchases. But I would also say, if you want to talk with us about the accounts, how we're setting them, what your risk tolerance is, I'd be happy to spend some time with you going over that. Now, let's take this a little bit further here and delve down into some of the actual numbers. So when we look at the various sectors that make up the U.S. economy, communications, technology, consumer, if we look back for the last 90 days, 3 months, we can see how the performance has been in more than half of these areas. They've had positive or plus growth looking forward here. And 3 of them, materials, real estate, and energy, have had negatives growth, have had negative or loss during the same time frame. Energy, probably because there's more supply than demand at this point. And that supply, because of drill baby drill, just continues to expand, which means it's probably going to help to keep energy prices low, which will probably help to keep consumer prices low. We will see as we go through the next few months on that. Real estate continues to struggle a bit since we had the rate hikes back in 2022. Those have slowed down the real estate market. I know several people who have their houses on the market and they're not getting much interest at this point in time because, again, it's a tough time to get money from banks, and it's a tough time because there doesn't seem to be much competition in the markets at this point because people don't seem to be interested in buying yet. But I do think that that's probably going to change here at some point. When? Well, nobody knows, and we're watching carefully just like you are. Materials, I will tell you, I thought materials would be taking off sooner. It certainly is one of the areas where we're seeing a lot of information in the background of it, but it just isn't showing itself yet. Think that one of the challenges are that the Russell 2000, which is a representative of the 2,000 largest companies in America by various industries, we were watching that, hoping we would see something from that particularly, rather than just try to go to an ETF that deals with materials. But the problem is there's lots of what we call zombie companies inside the Russell 2000, companies that haven't performed for a very long time and probably are not going to perform anytime soon. They're probably just either at a lull or waiting to be purchased by somebody else, or maybe their owners are going to go out of business at some point and retire. Don't really know. But I think materials, especially if there's going to be an increased growth for things like AI, infrastructure issues, making sure you got power lines, roads, buildings, all of that to help with that, probably will have a big impact. I would say, though, that I think real estate probably is also having an impact on why that's not growing much yet. Again, these, as we talk about the various sectors, which you may remember from other times we've talked, you've got a sector rotation model that, based on the current economy, what's going on in the economy itself, then has a leading indicator on what happens with the various industries we're looking at. And so as that economy shows itself, I think you'll see these two probably start to move up, which is one of the things we're looking for. Having said that, though, industrials are doing well. And I say, well, they're starting to do well. And they weren't doing so well a couple of months ago. So this should be a good sign. Utilities, consumer staples, healthcare sector, financial sectors obviously starting to take off, consumer discretionary, technology and communications, which these two have really started to show some growth and some strength. So individual securities or exchange traded funds connected to these three areas probably is going to be very positive over the next few quarters. Again, part of what we're looking at, and be happy to talk more in detail with you about your portfolio if you'd like. When we look at the industry summary, we can see that, let's see here, let's go out for 3 months just like before. And we can see which industries are doing better. Again, communications really looks like it's undervalued. If we want to pick on, say, internet, for instance, we can see internet is well above its 200-day moving average, as well as its 50 and its 20. This means this could be something that has what's called momentum. Momentum is a driving force that causes you to say, hey, this is exciting, we've got opportunities here. Lack of momentum tends to be scary to people. And sometimes there's great opportunities in that as well, assuming that the basics are there and ready to grow. So we're seeing the communications, consumer discretionary. Again, we can pick out, let's see, we don't want to be so selective here. Let's go with clothing and accessories, for instance. You can see clothing and accessories. People are buying to update clothing and for work and all kinds of reasons. We can continue on down here. Consumer staples, food retailers, we can see they're doing well. And you can tell in over here, some are not doing as well, some are doing better. This is part of how we can choose different securities or ETFs that are more growth oriented to help. You can tell here, energy, there's just nothing good going on in energy right now. Yeah, I think because there's a concern that if supply is too great and oil prices are too low, it's gonna be hard for these groups to make money. So financials, we can look at banks are doing pretty well. Financial administration is doing pretty well. Insurance brokers, investment services, I can tell you that's doing well also. Consumer finance, these are areas where we can see that the performance has plenty of momentum and things to look for here as we go into the next 1 to 3 quarters. Healthcare, we can see again, some are doing well, some are not doing as well. Industrials, again, airlines, which I have to say, based on just the prior couple of weeks with the accidents and so on, but airlines has still held its own. I think this is honestly more back here than what's happened just recently. I think that's why you see that pullback. I would say defense. I've been kind of surprised that defense hasn't taken off more. We've been watching that as well. Commercial vehicles, trucks, industrials is just starting to take off. We don't see much momentum there yet, but it is something to watch for. Materials we just talked about, real estate we've talked about, technology, electronic equipment, computer hardware, telecommunications. These are all areas that we're looking at for either individual securities, or we're looking at for exchange traded funds, which are broader groups to choose some of these indexes for. Utilities, these are all areas which we think will have some value, especially as the economy really appears that it is doing well, that it's going well. And so with that in mind, hopefully that gives you a little bit of confidence that as we take a look at what to do in your portfolio, especially when we talk here over the next few months with each of you, that this will be a great opportunity for you to adjust the portfolio. And if you want to look at whether or not you are ready to take a little more risk in your portfolio, not going crazy with it, but just a little more risk, this may be one of those great times, especially this year to start looking at that. So if you have questions or concerns, again, give us a call at the office. I'd be happy to talk with you about your portfolio specifically to help make sure that we're on the right track for you. We're matching portfolios, as always, to what your risk tolerance is, but with a conversation that you imply or express greater desire for a little more risk in the portfolio and a little more opportunity for return, more than happy to have that conversation with you. All right, let's go back over here. So as I said before, we can take a look at the S&P 500, which are the 500 largest companies in America, that we're easily staying up here in our ceilings, ceilings of resistance, and either bouncing into them or breaking above them, which is what we like to see. And hopefully we're going to see more of that, especially right in here. I know it's flattened out right recently, but I think that's probably going to continue to take off as we see more confidence in the economy and different aspects of life, Main Street, Wall Street, et cetera. To that point, as I was saying before, we also have the way we manage here. This happens to be the thumbnail charts we look at for our exchange traded funds that are growth oriented. And you can tell what we do is we order that by 6-month period of time, relative strength indicator. This is how we're able to tell quickly what we think is happening and then begin to drill down in more detail for these various pieces. It's how we're able to pick and choose investments. Again, nobody's perfect. I want to just say that clearly. Everybody gets it wrong occasionally. And so our history is the same. We've worked hard to catch a number of ideas right and other investment concepts in time to make it so there's opportunity for growth there and either single digits or even double digit returns. But the market's a complex environment, lots of changes, lots of things that you don't even think about that can cause problems. And so we look to be aggressive wherever we can based upon your risk tolerance, and then reactive wherever we need to be to make sure that we are protecting what we've been working on. We think of this as a grow and protect model, not just a buy and hold, but a grow and protect model. And so this is one of the tools I talked more about last month, but this is one of the tools we use to help us stay on top of all that for you. At the end of it, no matter what we're doing on our side, it really does come back to ultimately you as the investor. So as we've talked before, fundamental analytics is how we identify companies and industries, look at economic strengths and weaknesses, trying to assess what we think is going to happen over the next anywhere from 1 to 6 quarters. Technical analytics helps us identify if we would buy into something or sell out of something at this point in time. As I've said before, we might find something over here that we think is a great opportunity, but we just don't think it's a great opportunity today. And so we keep a large watch list of securities that we look for income, for growth. On the growth, we're looking at both individual and pooled securities like exchange traded funds as ways to help us identify opportunities for clients. And then we're able to build those portfolios, which I'm going to spend more time talking about next month, how we actually can put together portfolios to manage with an individual's risk tolerance, having some more aggressive and some more conservative to match out what their total risk tolerance is. But that brings me to the last piece here is behavioral analytics, because, I can tell you that every once in a while, and I've actually had this recently where I had a client that I thought we were investing everything to the way that they wanted it. They were more risk avoider. But in the course of conversation, they found out one of their neighbors was doing significantly better than they are, return on performance. And so the conversation has been over the last few weeks about why weren't we invested more aggressively? And that really comes back to behavioral analytics, where we have to assess based on what you tell us, based on your involvement, whether you're more passive or more active, what we should invest in for you. So for instance, and you've taken our risk analytics software called Nitrogen, you know that your score can be 1, full-on risk avoider, to 99, full-on risk taker. And if you are a risk avoider, or let's just say you're somewhere in the middle, let's say you're at a 40, that means you're going to be more on the risk avoider side. And so we're going to invest accordingly to that, which means that using the example, say the S&P 500, if the S&P 500 does 20% and you're invested because of your risk nature at a 40 on that 20%, you're only going to get about 8% of that. you won't get at 50%. If you scored a 50 on your risk scoring, you'd probably be invested to accomplish half of that. That way you would not have too much risk. Conversely, if the markets fall, then what you're going to find is that you won't fall as fast. So if the market falls 20%, then you should fall at maybe 10 or less percent if you're at a 50 or a 40. So behavioral analytics is how we tie together fundamental and technical analytics with an individual's risk tolerance and their portfolio needs. Another aspect of behavioral analytics is this need for income or growth or flexibility or cash reserve. Those are all pieces that we build into the behavioral analytics for putting together a portfolio to make sure that your portfolio matches your needs and your goals, and that we're investing in a way that honors what you've told us you want to do when it comes to your risk tolerance. So this sort of 3D investing strategy really is more about helping to identify what we think is happening and to do our best to predict that when it comes to fundamentals and technicals, and then to build that within the confines of the rules we have from our clients. So the more risk avoider you are, the more conservative your portfolio is going to be, the more risk taker you are, the more aggressive your portfolio will be. And if we've done our job right and we've understood what your needs are, we can match it to your growth and income needs as well as your risk modeling as well. Now, you may remember that in our last advisory review, we talked about the 8 investor types, and those are, again, the active investor versus the passive investor, the growth investor versus the value investor, the income investor versus the speculative investor, the defensive investor versus the impact or socially responsible investor. And you might have several of these pieces. You might say, for instance, well, Frank, I'm definitely an income investor because I have that need, but I also want to have a little more growth in the portfolio. Or I like finding things on sale, so I'm more of a value investor. Or maybe you say, you know, I really want to be involved in this conversation, so I want to be active, even though I'm also focused on growth or income. Or I've got plenty I'm doing in life. I don't have time to look at this, so I want to be more passive, which is fine. And you can still be growth or value or income. So understanding how these types work and then recognizing what you are and then how you want us to interact with that helps us do our job better when it comes to the behavioral aspects of managing your portfolio. Our job is to look at the fundamentals and the technicals, but the behavioral comes from a good understanding between you and myself or our team as to how to put together your programs that match your goals and your needs. So hopefully with that, you have an understanding of how to do that, because all of that comes together for what we call intelligent portfolio management, because it's the ability to identify the many investment opportunities out here. Cash reserve investments, bonds, equities or stocks, real estate opportunities, both pooled or more individual programs, tangibles, things like commodities or precious metals or energy, currency, the US dollar against the world, business interests, more private programs that are not being traded publicly like equities, but still have growth and income opportunities. And then for those who want some extra protections built into their portfolio, insurance and annuity strategies, which will give you riders or protection mechanisms to protect income or principal or both. So by developing a portfolio that deals with the various aspects, understanding your investment needs, your risk tolerances, looking at all that in light of the market and economic conditions is how we're able to build a portfolio where we can be proactive wherever possible and reactive whenever necessary. And the more that you and I are on the same page, the easier it is for us to manage intelligently what it is you're looking for in your portfolio management solutions. So hopefully, as we move into this year and start taking investment opportunities and look at how to handle certain aspects, this will give you some more insight into what we're doing. It's not just throwing darts at a wall and say, we're going to invest in this now for a while. It's really trying to assess what is the best strategy going forward, and then making sure that's implemented intelligently, and then opportunities to either take advantage of it for more or to pull back whenever things are changing on us. That's all part of this portfolio management solution to help you grow your family wealth, or to protect your family wealth, or to generate your retirement income from your family wealth. So our process, whether it's planning or investments or insurance management, is what we call client-driven, advisor-managed. And simply put, what that means is that we're constantly trying to figure out what you want and need, and then manage that process from an advisory viewpoint to help accomplish it. Now, built in that is a simple little thought that really is critical, and that is, if you don't know what you want, it makes it harder for us to do our job. So for instance, if you say, I want growth, but I don't want to lose any money, that's really not going to work. If you say, I got to have lots of income, but I don't ever want to take money from my principal, unless you have lots and lots of money, that's probably not going to work either. There are aspects that we spend time talking with clients about, trying to drill down and understand what it is you want to do. In some ways, it's not very complex at all, but in other ways, because we're dealing with two human beings trying to understand each other, it can be incredibly complex. And so my encouragement as we move into the investment portion of this year, and well, I guess we're always in the investment portion, but investment strategies that we go through this year, is the more you know about what you want and the more you understand how what you want will impact your situation, the more you communicate that with us, the easier it is for us to do our job in a way that achieves your goals. So our goal always is to be client-driven, you first, advisor-managed, us trying to handle each piece in a way that will work well for you. I would say built into that is one other thought, and that is, if we can't do what you're asking, we're going to tell you that. It wouldn't make any sense to tell you that we can do something that you don't want us to do, or that tell you we can do something that we can't do. So we work very hard to try to make sure that we understand what you want and then make that happen. I would tell you that sometimes down the road, we find out that as you go through an experience, you might be like, oh, I thought that's what I wanted, but I don't. That's okay. We can work with that. But again, the more you can help us understand what you want, the better we can do our job to help you accomplish that. Because in the end of this, it's right here, helping you accomplish your family wealth goals today, tomorrow, and for future generations. You work hard to build this wealth up. You have to sacrifice to make things happen. You want to make sure you do it well. And so if we're going to do that, the power of compounding, the time value of money, means that we can do a lot today, but even more for tomorrow and even more for future generations if we planned wisely in our planning processes and our wealth management and risk management processes. You know, I talk about this a lot, and I'm sure that most of you have seen this, but it really bears repeating, because we brought in a new client and I went over this with them, and they were very impressed with it. Sometimes you forget how something that you've seen so many times is really critical. So we call this the 3 phases of your financial journey. You have the accumulation phase, pre-retirement, the decumulation phase, post-retirement, and then the transfer phase, when you've passing these resources on to the people you love and care about. Built within that is an understanding that as you're building this money, we want to help you achieve your desired return on life. What is your desired return on life? I said a moment ago, if you know what you want, it's easier for us to do our job better. And that doesn't include just things like your growth or income needs, your risk tolerance. Those are all givens. We have to know that. But if you know what you want, if you know what your bucket list is, if you know what your transitional issues you have to deal with because of family issues or business issues, the more we understand that, the easier it is for us to do our job, because nothing's harder to do than when you go down a path thinking you're on the right track and then something comes in and messes it up. That's why we try hard with our planning processes to stay on top of that, because we know that direction determines destination. If you have identified your destination and we're on the right path to that with that direction, then we're all going to be happy. But if you don't know your destination, it makes it harder for us to do our job. Fact is, I had a client not long ago, about a month ago, that they had done planning with us last year. But when we sat down and looked at it, I said, I don't really feel like we understand your direction. They really couldn't add a lot to it because I think they're still trying to figure it out. And so we said, well, let's just not do planning this year. Let's just work with investment management and help take care of various pieces. But in the end, if we understand the direction that you, or in this case, they want to go, we can put things together much better for that. And to that point, uncertainty is the only thing that's certain. The only thing that I know for certain is that I don't know what's going to happen this year. I have opinions, I have beliefs, I have made predictions, but in the end, I don't really know what's going to happen until I get there. And so we have our plans if things go like we want, we have backup plans in case things don't, and we're prepared for various aspects of this. So all of this together on this little chart, which seems like it's kind of simple, it actually is very complex because it's designed to help you understand where you are on your financial journey, what's next, and then help you to make the most of that along the way as we seek to help you accomplish your desired return on life. We know you need to have return on investment and return on equity. We get that. But return on life, that's what you and I are going to remember most when we are finished with all of this. So to that point, this is why we provide your financial dashboard. The IXL financial dashboard is just more than this. It's actually, this piece is your personal financial dashboard, which shows income and outgo, what you own and what you owe. It consolidates all your information together. It really helps to bring about organization to your life in an easy format. If all of your institutions link with this website, which I'd be surprised that most don't, based on our experience working with eMoney, if they do, it actually keeps telling you and updating everything for you automatically. You don't have to do anything. And then we're able to take this information and then extrapolate it into the future for your retirement, for your trip of a lifetime, for a business idea you want to do, or for college education. We're able to take all of this and tie it together. And there's other pieces to what we think of as your IXL financial dashboard, but this is sort of the centerpiece to help our clients have the information they need updated on a daily basis, 24/7, 365, to be able to know where they are and where they're going. That is this piece right here, your financial dashboard, the eMoney program we use. But we also have our portfolio dashboard, which is how we help you understand performance on our side. So the IXL wealth management system is really designed to these 4 items. Your portfolio dashboard helps you understand numbers of what we're doing and how that's working, or if it's not working like you want, how we can adjust it. Your risk reward evaluation, I mentioned nitrogen before. If you have not taken your nitrogen score, we need to, so that we can then make sure that we're managing your money according to your risk tolerance. The good thing about it is, or one of the cool things about it is, that if you have money outside of us, like a 401k or a trust account that you can't move, we can include those dollars in your nitrogen score so you can tell if they're invested according to your score. So let's say you scored a 75 on your nitrogen score, but that portfolio, like your 401k, let's say it's set up for a 40. Or let's say it's set up for a 90. Understanding that could be critical to helping you either bump up your returns to where you want them to be or reduce your risk to where you need it to be. And then when it comes to return on life, your financial life plan is here. This is the part that brings me a great deal of joy. Because again, I know that you need these things, and these are sort of essentials, but this is where we take your facts and your feelings and attach it to your facts and figures and attach it to your feelings and desires. And that's how we can achieve that return on life. So if we understand the mechanics of what you need, and we understand your life goals or bucket list items and your transitional life items, we can really tie together these 4 applications to help you create that IXL wealth management system. Again, I think most of you on this call are using it. If you're not, talk to us. I'd love to share it with you, show you how it works, and see if this would help you. So this is that time where we have some questions. You might think, well, we're way ahead of time. I'm probably about 15 minutes ahead of time right now. But part of it is because really not that much changed in the world and the economy since we talked last time. I updated you on a few systems. I wanted to spend more time next month talking about how we synchronize portfolios for risk management and growth and income and so on. But for tonight, I thought I'd just spend some time really with the economy and the markets and what's happening. So I'm giving you a second here. If you have any questions, this would be a great time. Let me just check and see. I don't see any questions. Okay, yep, that's good for there. We'll come back to that in a second. So our next update is March 11th, 2025. And we're going to spend more time talking about a few of these points, but really going to drive down into how we actually can build a portfolio that matches a client's investment goals, growth, income, flexibility, cash reserve, et cetera, and matches it to their risk portfolio, their modeling for their risk tolerance. So we're going to talk more about that, as well as other planning issues and such. So hopefully that will help give you some new insights there. And again, as I've said before, if you have family or friends you'd like to invite to this, they are welcome. Anybody can attend. We just have to know ahead of time so we can send them an invite, and they are welcome to attend. And if they want to talk to us afterwards, great. And if they don't, no pressure there at all. Hopefully by now you all know that. So what we talked about now is the outlook for this year. What I continue to believe is a pretty positive outlook. The market tactical analysis, again, there's so many different pieces I could throw in, but after a while it just becomes overwhelming. So I thought, well, let me just hit the key points about inflation, rate hikes, what I think is happening there, what we see with the forward PE as far as company profitability, GDP, et cetera. All these pieces right now look good. There, again, may be some surprises that come as a result of tariffs or energy, or maybe just honestly some other things that we're not thinking about that may be sort of black swan events that'll pop up. Rest assured, though, if those happen, we've got plans in place for how we'll handle those and what we'll do differently as a result of that. So taking a look at that, plus the potential investment opportunities, showing you how we pull together different investment items. And, you know, if you're interested, we've got income funds that we are very fond of, that we look at, we track, we move in and out of as we think things are happening. But those income funds are excellent as far as producing very either high single or low double-digit returns for clients. We've got growth investments that are more pooled, like ETFs, exchange-traded funds, or some individuals that are more focused on areas like artificial intelligence, or maybe some of the areas we were looking at before with technology and communications. So we have these different items that we have in our portfolio watch list and items that we're investing. And so if you'd like to talk more about those, we're happy to sit down and go over those in detail so you could see how those might fit with your portfolio, even as it relates to, and I'll show more about this next month, your risk management model inside your portfolio. The 8 types of investors, I'm hoping that you're beginning to think through that for yourself. Understanding who you are and what you want is incredibly helpful for us to do a good job for you. You know, it's one thing to go to a doctor and say, hey, doc, I got a pain here. It's another thing to go to an accountant and say, hey, I've got a tax problem. It's another thing to go to a lawyer and say, hey, I've got a real estate issue, or I've got a legal matter I got to take care of. When it comes to working with a financial advisor, it really is a very personal relationship. You don't get much closer to a financial advisor than you do anybody else, because they're working with your wallet. They're helping you with all your family's finances. They're bringing together multiple pieces in a very complex environment. I mean, if your doctor says, try this drug, they pretty much have a good idea what's going to happen with that, unless you have a side effect that they've prepped you on, but maybe makes so you can't keep taking it. When it comes to investing, trust me, there are plenty of times that we've looked at investments and they've done better than we thought they were going to, worse than we thought they were going to, and a few times where it came out exactly like we wanted it to come to. But tying all that together with tax management and income goals and having liquidity when you need it and meeting family desires, that's why this is a very complex process. And so, again, the more you know about what you want, the easier it is for us to do the job, and the better it's going to be for both of us. Which brings me to our difference, how we handle portfolio management. Again, I've shared this over the years with you at different times in different ways. Hopefully you're beginning to see how we manage money, how we work diligently to find the right programs to put in, and then try to put a process together that makes it so we can manage that for you. And I would say, above all, our client-driven, advisor-managed approach is how we tie together financial planning, investment management, risk management. And so those are some of the key things that I'm hoping you walked away with tonight. I'm going to check again for questions here. You are aware of the upcoming investor advisory on March 11th. And so hopefully you'll be able to join us with that. Let's see, don't see any questions, don't see any raised hands. So I think it's like we're good there. So we're having an early night tonight. I get to go have dinner with Jane early, unless any of you raise your hand or have a question here in the next minute or so. Again, if you would like to invite friends or family to these updates, you are welcome to. You can just let Megan know and she can send them an evite, or you could actually say to them, here's their information. They can reach out to our company, check our website out at www.frankreynoldscompany.com, and they can get a feel for what we're doing. All of this is available to you, and it's all designed to do one thing, and that is help you achieve the goals. We have a long-term relationship with many of our clients, And that's what we want to do, continue that, maintain that long-term relationship, because again, it's a pretty close and important relationship when it's done well and it's done right. And that's important and critical to me and our whole team, to be honest with you. All right, I'm checking one more time here for questions. Okay, doesn't look like there's any questions. Matter of fact, it looks like a few of you have already left because you're going to dinner too. I will look forward to our next conversation, the next Wealth Advisor Review. But as always, if you have any questions, we are here for you anytime. And I will look forward to catching up with you and answering those questions and helping you achieve your maximum return on life. Oh, looks like there might be something right here. What we got? This is, let's see here, Q&A. Look at that, somebody wrote a Q&A. How are you doing? I'm doing better, Kevin. I am. I'll get with you on it, but I'm doing much, much better. Thank you for asking. You guys are awesome. I appreciate that. And I appreciate your prayers too. For those of you who don't know, I had a bit of a health problem, nothing major. It's actually more, it's dealing with, prostate issues and so on, but nothing major, no cancer, nothing like that. But it was pretty exhausting for a period of time. And if you want to know details, I'll share with you some other time. But I am doing better, but I still have some things I'm dealing with here that hopefully by the end of this week will be dealt with. And so I'll be back to normal 110% again. So, all right, my friends, I appreciate you all. I love you. God bless. And I look forward to talking to you all soon. Oh, here's another question. Let me make sure it's nothing critical that I can deal with. Oh, very good. Thank you, sir. Thank you. I appreciate that. I do try to sound great. I don't always get it done, but I appreciate that. All right. Have a wonderful evening and a fantastic week and weekend. And I will look forward to talking to you all soon. God bless and have a great, great night. Thank you.